Good evening, ladies and gentlemen. Welcome to our first Corporate Connect of the year, jointly organized by SIAS and supported by SGX. Today, we have with us Mr. Geoff Howie, the market strategist of FGX, to share with us on the market updates, followed by Southern Mining Alliance's presentation and Q&A session. So without further ado, let's welcome our first speaker, Mr. Geoff Howie from SGX. Over to you, Geoff.
Thanks, Julian. Just give me 1 second to get the sharing down packed. I think that's it. Okay. Good to go. Good evening, everybody. I'm Geoff. I'm the SGX market strategist and intend to provide a quick overview over the next 20 minutes or so on the current drivers of the Singapore stock market. And I guess some perspectives through the prisms of the companies and the trusts, in addition to, I guess, the active hundreds of thousands of investors that are actively participating in our market. So I must point out the presentation is designed to be purely informative, with recent observations predominantly on the stock market, and in no way provides investment advice. Now, I've got these two lines here, the blue and the green line, and I wanted to start with this just to provide some context. The blue line is the STI, and the green line is the FTSE ASEAN All Share Index. So the day-to-day moves of our Straits Times Index are 95% correlated with the FTSE ASEAN All Share Index. Singapore stocks, they currently make up less than 25% of the FTSE ASEAN All Share Index, which this bigger, broader regional index has a combined market capitalization near $3 trillion, which is effectively 5 times the size of the STI. And importantly, like the STI, this FTSE ASEAN All Share Index, its biggest sectors are financials, real estate, and industrials. Now, for these three mega sectors to recover further, broader economic recoveries would have to be seen here in Singapore as well as across the region, as opposed to, I guess, that uneven K-shaped sequential growth that we really observed in the second half of 2020. Now, this is different to the S&P 500 and by extension, the FTSE All World Index, because those two indices maintain an approximate 40% weighting to the two key sectors that benefited the most from the lockdowns, and that was the, I guess, the digitalization and the medical supply industries, technology and healthcare ultimately. But nevertheless, look, investors have been building their STI exposures in 2020 and in the first month of 2021. The combined assets under management of the SPDR STI ETF and the Nikko AM Singapore STI ETF, they ended, the combined AUM ended 2020 at 2.1 billion Singapore dollars and ended January at 2.2 billion Singapore dollars. So it took 17 years for the assets under management of the STI ETFs to reach $1 billion. And that was in June 2019. And then it took 17 months only for the two ETFs to reach $2 billion threshold of AUM in November 2020. So likewise, I guess, interesting that the 30 STI constituents, or the current 30 STI constituents, they were recipient to $7.5 billion of net retail inflows back in 2020. After the same 30 stocks saw outflows of around 1.2 billion in 2019. And so far in 2021, the 30 stocks have seen net retail inflows of around $150 million. So for the STI in early 2021, it has gained, I guess, 3%, a little bit over 3% so far. And it has closed above the 3,000 level twice. Firstly, on the 15th of January, and then again on the 21st of January. Hence, I guess it appeared to have that 3,000 psychological level. It appeared to provide some recent level of resistance, I guess, after it last provided support for the STI, as you can see back in the chart there, around November 2018 and January 2019. But from the current levels, for the STI to recover to the early 2020 high near 3280 that was made a year ago, it would have to rally 12%. To return to its 12-year high of 3640, it would have to rally 24% from here. And likewise for the STI to return to the pre-November level of 2420, it would have to decline by as much as 17%. Now, what is the key driver? The overarching driver of not just the STI, but all finance financial markets is very much the social and the economic. They currently account for close to 80% by the WHO. The US and the Eurozone, they make up 2 of the G3 and contribute a third to sorry, I'm just getting a message that I was losing everybody, but I think we're all okay. But anyway, that these 2 economies have such an important role in the world. They contribute a third of the world's global trade and 2/5 of the global GDP pie. Their policy responses to offset these economic impacts hence have had a big global impact. And the Fed Reserve balance sheet, it's grown by something like 80% over the past 12 months. And the European Central Bank balance sheet is also up more than 40% over the past 12 months. So that's helped support businesses in all different shapes and sizes. And by extension, it's helped fuel the moves in the stocks, the global indices, and of course, commodity prices as well. However, overcoming the coronavirus, for now, it really is the sole objective, and the time in which we find the new norms, not just the new norms for us, but the new multilateral norms. It's going to very much depend on vaccine deployment, efficacy of the vaccine, and of course, across the world, this continued second line of defense measures that we're well accustomed to here at home in Singapore. But this is going to be really important as well, as the world will see, to reduce the mutations and the resurgences and so forth. But all this basically means is that the week-to-week progress in overcoming the coronavirus has become the biggest overarching driver of the week-to-week moves in the global stock market and, of course, the Singapore stock market. Now, stock markets are always forward-looking, and this earnings season, guidance and outlooks are going to be just as important to investors as the financial results from the last 6 months or so, and the last 12 months to that extent. So far this year, we have seen some moderation in those big rotations in November. For instance, over the past 6 weeks, Gunting Singapore, Singapore Airlines, and SATS have still been among the top half of the STI's performers, but they've averaged more moderate 2% gains. The hospitality trusts, Far East Hospitality Trust, Fraser's Hospitality Trust, Ascot Residence Trust, and CDL Hospitality Trusts, they've averaged 6% decline so far over the past 6 weeks. But those 4 trusts, remember, averaged a 26%, snapback over the last 2 months of 2020. So you've got a little bit of moderation in there, but really what the STI is going to depend on, not so much the smaller stocks, but really the much of the STI performance in 2021 will hinge on the performance of the banks. And good time to just quickly look over the banks, because DBS is the first of the banks to report their full year 20 numbers tomorrow morning before the open. So stock market returns since April, as we've discussed at these SIAS forums over Zoom rather than the auditorium, as we miss doing, the stock market returns since April, they've been staunchly sector driven. Sector composition, I guess, has been the real key determinant of what drives the indices. Much of the movements in the 3 banks, DBS, OCBC, and UOB, have been correlated with the day-to-day moves of global bank indices, more than 90% correlated. Now these 3 banks, they make up 40% of the STI, and just like big global banks, they're facing the same kind of income provision challenges, and for that reason, they have moved mostly in unison. Financial services have also been, I guess, amongst the sectors that benefited the most from that rotation from the industries with momentum, those smaller industries like medical supplies and work from home related technologies, to the bigger value sectors in November. And hence, I mean, the moves you could look at the first 3 quarters of last year. The trio, DBS, OCBC, and UOB, they averaged just over 20% declines on close to $4 billion of net institutional outflow. Then for the 4th quarter, the trio averaged more than 20% gain on around $1.5 billion of net institutional inflow. So that's pretty much the picture of what the big global banks have been doing. As shown in this chart in the bottom right, you can see the three banks have consecutively reported combined net interest income above the 5 billion mark since the first quarter of FY 2018, which was the March 2018 quarter. The trio also averaged a return on equity of 11%, and that compares to, I think, to a median ROE of the top quartile of global listed banks at around 8%. And growing income is important, and we should point out over since 9 years since the end of 2010, DBS, OCBC, and UOB have increased their annual income segmented to China, I should say Greater China, by 175%. Now the trio, they trimmed their FY20 dividends to 60% of the FY19 levels. That, remember, was to bolster the ability to serve credit needs and absorb potential shocks. But at the same time, they still remain amongst the top 10 constituents of the FTSE Developed Asia Pacific ex Japan Sustainable Yield Index. And Global Finance magazine also ranked the three banks as Asia's safest banks again for 2020. Now, in terms of where they are on a valuation basis, the median price to book ratio of the three banks is pretty much currently book value. The trio average a PB ratio a little higher than the median because of DBS and a little bit of a skew, but the trio average a PB ratio of 1.07 times. Now that is right in between the median of the top quintile of global banks by market value at 1.06% and the median of the top quartile of global banks at 1.08 times. So this comes after the banks were trading at around a 16% discount to their book value at the end of October. And that snap back basically saw them move back to book value, which is what we saw for all the world's biggest banks. Now, while they're back at book value, they still are well off that 40% premium, or that 1.4 times book value that we saw in April and May of 2018. Now, for those banks to get to PBs at around the 1.4 level again, what would we need to see? Well, you might recall that back in 2017, Singapore was amongst the world's, if not the world's strongest advanced economy that year, and also home to one of the world, I think it was first equal, one of the world's strongest performing stock markets for that year back in 2017. So the evidence, I guess, of the broad economy doing well, it will be evident for investors as an observation point to assess how the banks are faring and what impact those banks may have on the STI. But I guess key sub-themes for the bank sector to watch for the remainder of the year, obviously the ability to expand non-interest income, that potential for lower provisions now. I guess net interest margin stabilization will also be really important, and of course focus on the extent of the broader earnings and economic recovery. Digitalization is also pretty important. We're expected to see banks embrace more emerging frontline technologies, and that they also do provide a means for new consumer-orientated entrants into the sector as well. Okay, so for the results, watch DBS. They will report before the open tomorrow morning, and OCBC won't be reporting until before the open on the 24th of February, and then UOB before the open on the 25th of February. So I've just got two more slides over the next 5 minutes, and that's to focus on another pinnacle part of our stock market, the manufacturing sector. It was a very important contributor to the economy in 2020 for us. Advanced estimates show that the sector grew by 7% in 2020, rebounding from that 1.4% decline in the previous year of 2019. And the strategic importance of the sector, it was reiterated, I think it was back on 25th of January, Minister Chan Chun Sing announced a new 10-year plan to grow Singapore's manufacturing sector by 50% and maintain its share of about 20% of GDP. Now, the manufacturing stocks in Singapore also make up 20% of our day-to-day turnover. Our SIPMM PMI, it rose 0.2 points to 50.7 in January, and that's 7 straight months of expansion. The past 3 months as well, we've seen the two sub-indices of the PMI, which declined the most from January 2018 to October 2020. That's new orders and output. They have continued to increase. So I guess back in just for context, back in 2018, January 2018, that's when the SIPMM PMI recorded its highest expansion since December 2009. Okay, and that followed that's very strong year that we talked about in the Singapore economy, but it also coincided with the US announcing tariffs on solar panels and washing machines, which was the key beachhead in the recent US-China trade tensions. So at 51.0, the electronics PMI, it's declined to 0.2 from points in January, but from a 27-month high in December 2020. And the pickup, what's exciting is we've seen the pickup in broader manufacturing, and that's also evident in the industrial production reports that we saw released on 26th of January. If you look at the multicolored line in the top right, you can see that you're looking at that EDB industrial production sub-index for semiconductors and electronics at the top, but then looking at the petroleum and the transportation engineering at the lower part of the chart, what you can see is that the sub-indices are slowly disbanding that K-shape in the relative performances that were clearly evident from April through to August. So sentiment's also been improving in the region, I should say, as well. By the end of 2020, the IHS market PMIs for Asia, they range between 49.1 for Malaysia to 59.4 for Taiwan. Japan was back at 50 after being in contraction since May 2019. And you've got confidence across the regional supply chain. It rebounded pretty quickly from those lows in April, and the average PMI of the 9 Asian countries that are covered by this sub-indices have continued to inch higher. So looking at the stocks themselves, the 30 most traded manufacturing stocks here, or I guess stocks with manufacturing related activities, they do maintain a market cap of around 130 billion Sing dollars. And so far in 2021, they've averaged more than $350 million a day in turnover. And it basically means the 30 stocks that out of the most traded manufacturing stocks, they make up 14% of the total market cap, but 25% of the day-to-day turnover. So they have much bit more impact in trading turnover than they do in terms of market cap. Now, the 30 most traded stocks, they've averaged a 29% gain in the first, I guess, those first 5 weeks of the year between the end of 2020 and the 2nd of February. But there was a less skewed median gain of around 16%. Now, the 30 businesses, they span multiple sectors. There's consumer non-cyclicals, that's like the food and beverage processing, food and beverage products. There's industrials, there's healthcare, there's materials and resources, in addition to technology. Now, the demand for medical supplies and technological equipment have been, I guess, more of the entrenched drivers of the goods producing stocks. But the more recent catalysts, they are including, I guess, those manufacturing companies that are able to find industrial supply chain efficiencies. And then there's also the rising commodity prices, there's rising food prices, and expectations for economic rebounds, particularly in China and India. And I guess also regional supply chains have seen a lot of restructuring in years as well. And that's been driven by the rise of the Asia's purchasing power, in addition to technology, communication, e-commerce developments. And this means that a lot of these traditional upstream companies are able to move downstream and directly face the growing pool of consumers. And that sub-trend has extended to various goods producing businesses here in Singapore. For instance, Singapore's most traded manufacturing related stock, you can see right up the top there, Wilmar International. It's basically in recent years established a very comprehensive sales and distribution network. So it's able to reach these traditional retail outlets, supermarkets, convenience stores, hypermarkets. And that means this company that was once upstream is now basically facing 5 billion consumers worldwide. And look, Wilmar has performed comparatively well in the first 5 weeks of this year, matching the gains it did last year. Now, Wilmar was also buying back its shares back in the 4th quarter of 2020. and that was the first time it had been buying them back since August 2016. Its YKA, close to 90% subsidiary, has been trading in Shenzhen on the Chinex board since the 15th of October, and there is a current valuation gap that sees YKA maintaining a PE ratio above 100 times compared to Wilmar's price to earnings ratio of close to 20 times, around 19 times. And look, in China, consumer goods stocks with a market value of at least $1 billion US, they do maintain a median PE ratio of around 45 times, close to 50 times. But that compares to peers across the exchanges of the APAC financial centers that generally trade in the consumer goods sectors with a median PE ratio of around 20 times. So look, the past 3 months, I'm going to wrap up now. The past 3 months have seen oil prices as well basically triple the gains of the stock market. There's been a very important structural upward repricing on most commodities with the weaker US dollar. And there's also, I guess, been reduced oil output and drawdown of crude oil stocks, which has also been having an impact with, of course, the key overarching demand driver of the vaccine deployment. So in addition, for the energy markets, supply drivers were also key contributors to those more rapid gains for crude oil, with key developments being the 2 OPEC plus full ministerial meetings that were held back in December, held back in January, and effectively Saudi Arabia producing at around 80% of its capacity of oil. The next full ministerial meeting is scheduled for the 4th of March. That will be a key date. Nevertheless, over the past 5 years, our 2 most traded energy plays, which is upstream catalyst listed Rex International and downstream China Aviation Oil, they have both generated similar gains. Average annualized returns for the pair over the last 5 years have been around 15%. So iron ore, I should say, has also been a very important part of the commodity rally. And Southern Alliance Mining, it's a relatively new stock listed here on Catalyst Board in Singapore. But since debuting in late June, it's generated a very close to 50% total return to investors. Over the same period, you've got Fortress Minerals, which has generated a little bit over a 40% total return. And I'm going to wrap up and really looking forward to listening to Southern Alliance Mining CFO Wei Hung very soon. But before I do that, just to point out again that much, I guess, of the present material in the presentation, it is based on our regular reports that are distributed through the Monday night SGX My Gateway newsletter, and of course our daily Telegram channel, SGX Invest. So I would encourage you to subscribe to these if you are not already receiving them. And of course, any questions, or if you'd like us to be on again in a couple of weeks with SIAS, don't hesitate to reach out to the SIAS team, because we obviously love working with SIAS, and I will hang around for the Q&A session soon. So let me finish off and stop the share, and it will be over to you guys. Thank you. Julian.
Thank you, Geoff, for sharing on the market updates. Next up, we are pleased to have with us today Mr. Lim Wei Hong, the CFO of Southern Mining Alliance, to share with us more on the company. Mr. Lim, please.
Thank you, Julian. So good evening, everyone. So thanks for coming to this webinar. So my name is Wei Hang. I'm the CFO of Southern Alliance Mining, or SAM. Right. So let me introduce a little bit of the company. So we are principally involved in the explorations and mining of iron ore, and our headquarters is in Pahang. And whereas our mine, which is Cha'ar Mine, one of the largest iron ore mine in Malaysia, actually located in Johor, and it's about 1.5 hour drive from Causeway. And we have commenced our operations in Cha'ar since 2008, and over the period until 31st July, we have actually extracted more than 5.3 million tons of iron ore from the mine, and we're still producing from the mine, and we also reporting good resources and reserve from the mine. So allow me to introduce our key management and the directors. All right. The founder of the company is Dato' Sri Pat. He has more than 18 years of experience in the mining industry. And so is our non-executive and non-independent chairman, Dr. T, who has more than 13 years of experience in the industry, and myself actually have more than 20 years of experience in financial reporting, and I have been with the company for the last 7 years. Right, this is a little bit of introductions to our mine. All right, so Chakra Mine is actually 1.5 hour drive from Johor Bahru Crossway, and is about 225 hectares, and with the mining lease expiring in 2024. So we still have, in addition to the Chakra Mine, we have 3 other explorations target or projects that we are currently doing the exploration program, with the area of 22.3 hectares to 79.2 hectares, right? With the mining lease expiring date from 2023 to 2024. And based on our past experience, there is no issue of renewing our mining lease. And in fact, our Chakra Mine have its mining lease renewed back in 2013. So we don't foresee any issue with that renewal of the mining lease. So allow me to actually introduce a little bit on the process, the mining process. So it will be a little bit of like an education program over here as well, so that the public will be aware as to the activities that are undertaken by a mining company. So first thing first, we will start with the exploration and immersion program, whereby we will have our geologists and mining engineer involved in this stage. So what basically they will be doing is that it's something like a CSI job by the geologists, because mineral actually is something that we can't see below the surface. So there involve a lot of processes that to do the discovery. So in the first stage, we'll have the geologists to carry out various exercise, okay, from what we call geophysics, which is to detect anomaly before we design with the drilling program, because drilling program is something a very expensive exercise. It can take millions and millions to discover and also the first part of the exercise, it will involve the geologists to carry out the exploration program. Once geologists have discovered, they will present their finding in terms of resources. That's why in mining industry, the geologists will be reporting resources. And with that, mining engineer will come to the picture. What they'll be doing is they'll carry out the feasibility study, right? Or in another terms, industry terms, we say converting resource to a reserve. Reserve basically is a model that whereby the mining engineer will take into considerations of mining factors. It will take into consideration of price forecast, cost structure to come out with a cash flow modeling or financial forecast, where when they do the discounting cash flow, as long as it's a positive cash flow, which is a valuation so-called, then there will be a reserve. So it is very important for all the investors, for everyone to understand the difference between resources and reserve, because resources is something that established by a geologist, and whereas reserve is something that being established by mining engineers. So it is important to understand that. Once we have established resources and reserves, means that it is something feasible to carry out, then we will do the extractions of the raw material. So it's involved a removal of the waste, and it will also in the context of iron ore industry over here, our company, that involve blastings of the ore. So once we blast, then we'll continue to do the size reduction process. First process we call crushing, right? We are crushing maybe 1 feet to 2 feet size of iron ore into a much smaller size to about 20 mm or 16 mm. So this is the product, the very first product that the company produced, right? And which is a very unique product by itself, because our end product we call pipe coating material, which is used by the pipe coating companies for oil and gas industry. It meant for the subsea pipe. So it is something very unique type of product, and it's our prime product, right? So it is something that the oil and gas industry using, particularly for the subsea pipe. So after crushing, right, and we will go to another process, what we call beneficiation, right? Beneficiation process here, basically in a way that we call to remove the waste from the ore, right? So in order for us to produce what we call iron ore concentrate with the Fe content or iron content between 62 to 65%. So what it means is that in 1 ton of the ore that we produce, it should consist 62% of the iron content, which is at least, so that we can sell to the steel miller. So this is meant for the steel industry. And currently we have all our product actually sold to the local steel mill, which make up of Alliance Steel, which is the largest in Malaysia, which is owned by Chinese, and also to Eastern Steel. So Berhad is the JV between Chinese and Malaysian, and also to this Anju Integrated, which is a subsidiary of this Anju listed in Bursa. So this is basically, generally, it will actually explain the whole mining process. So in order for us to do the mining activities, so we need to have a very big fleet of mining equipment. So these are the equipments that we have with the capacity, the quarterly capacity of theoretical capacity of 2.5 million ton. So this is important because your capacity will determine how much ore that you can extract. Just for your understanding, for example, the first row, excavator Caterpillar 390 model, what it meant is it is a 90-ton excavator, a digger, right? So it is something like the size of it is, or the weight of it is about 90 unit, more than 90 unit of sedan car. So this is a massive equipment. So we need that to do the mining. And with the ore that we have extracted, so what we need to do is we need to process them. So we have 2 plants over here. The ones that we call is, one is called HSM plant, one is called SSM plant. So these are 2 plants that actually concentrate the iron ore by removing the waste from, or impurities from the ore. So we have the capacity of 800,000 tons per annum with the 2 shifts working for HSM plant. And we have 700,000 of capacity for SHM plant. So in combined, we are able to process 1.5 million tons of iron ore, the raw ore, per annum based on 2 shifts, right? So these are the capacity. Right, so basically what you can see in this picture here is the pit of our mine. So it is the open pit mine, and you can see those machines are pretty small, just to show you the magnitude of how big is the mine, or the pit rather. So with that, so generally when it comes to understandings of this mining company, and you can't avoid from the terminology of mineral resource and reserve, right? So like I explained earlier on, is that for this mineral resource, it is a so-called CSI work, or the investigative work carried out by the geologists and through various techniques. And more importantly is that they have to do the drilling, okay, below the surface, so that they can establish or rather they want to establish the shape of the ore body. Right, so when we are able to do that, then we are able to report resource. I mean, in short. So, but there are various types of category of resource, right? As you can see on the left table here, the top part is measured. Measured means that something you are able to measure very, I would say, close to precisely. That this is a high level of confidence level of the resource category, and it followed by indicated, as what the terminology suggests, is indicate something, right? So like in our case here, we have actually reported 5.5 million ton of resource as at 31st July. So it means that this is indicated. So the importance of this indicated and measured resource is because we need them to be, in order for them to be eligible to be converted to a reserve. So when we say converted to reserve, basically is that the mining engineer needs to have a high level of confidence that this is something doable kind of program that they can develop, right? So of course, the lowest level that we are talking about, the resource is inferred category. So inferred means that like what the terms actually has suggested, it implies something because due to insufficiency of information. So as for the Southern Alliance, as at 31st July, we have reported a total in situ, meaning that unextracted ore of 7.3 million ton on the peak that we have actually carried out the exploration program. Of course, the exploration program is still ongoing. And next is that on the table on the right, so this is after the mining engineer has done their feasibility study, right? They came out with their own program, the mine schedule, everything. And very importantly is for us to look at is that the category, the first part is proof. Okay, is the proven category means that it very high level of the confidence as to this is something that you are able to do very, very well. Okay, and second category is probable. So probable is, of course, you suggest is something probable, right? And very, very important for everyone to take a look is that while the company may report, the mine may report resource, but is it everything can be converted to reserve? So in the case of the Southern Alliance, out of 5.5 million tons of indicated resource that was reported, we have converted close to 96%, meaning 5.3 million tons. So it is something very important, these conversions of this resource to a reserve. So because resource is something geologists has discovered, reserve is the mining engineer has computed that it can be economically extracted and produced. So in this context, Southern Alliance has actually converted 96% of its indicated resource. So, but as we all aware that resource and reserve, they are still estimate, right? Is an estimate by the specialists and the expert. So how reliable is that? So there's another product that very important here is that we call product reconciliation, right? Basically, it actually matching what the company has done, extracted, against what the model, resource model has suggested. Like for example, for the table on the left, you can see that that is project reconciliation for a period of June 2014 to July 2019. As you can see on the last row here, we are talking tracking and processing statistic. So this is based on the statistic produced by the company. And over that period, our statistic shows that there was a 3.4 million tons of ore that we have actually extracted. However, based on what the model has suggested, in the row number 3, right, it suggested that it should be about 3.37 million tons of ore that you are able to extract. So in that aspect, it means that over that period, the company has actually extracted more than what the model has suggested. So it is a good reconciliation. It means to say that whatever we have reported in our modeling, right, we are able to achieve 2% more than that. So it is a good reconciliation, and it actually gives the confidence to the company and also to the investors that, okay, this reporting of resources are actually is reasonable and good. And let us look at the reconciliations for the financial year 2020, right? Now, the last row here says that we actually produced from our 1.2 million tons from our own statistics, whereas the model actually suggested that total resource is supposed to be 830,000 tons. So in this aspect, we are actually extracted more, a lot more than what the model has suggested. So in this aspect, it is a positive variance. It's something that is good, but again, we have to investigate as to why there is such a big discrepancy so that we can improve further our modeling and also for the future reference. So like, for example, one of the reasons that we have discovered is due to the conservatism in the modeling, whereby we have classified certain mineralized ore as a waste instead of ore. So that actually gives us the confidence level as to, okay, this is something that it should be able to turn into a a value, a product by itself that can be sold. So this is very important part, meaning to say that you have one resource model and reserve, and now production reconciliation, which will tell, okay, how reliable is that going to be. So in short, this table actually tells something. Okay, the top part here on the left is actually what the resources, or rather we say opening balance, right? Opening balance as at beginning of the financial year 2020. And based on the model, right, we have actually removed 900,000 tons of waste, and we have actually extracted 1.2 million tons of ore. So this is what we have reported. At the bottom there, the remaining resources is about 7.3 million tons left for the existing peak area that the company has actually carried out the exploration. Of course, we are still continue to do the explorations, so that we will hope that if we discover something, we are able to enhance further our resource and model. So based on the ore, 1.2 million tons of ore, obviously it has to go through the other processes that we explained just now, and some may be end up with the closing stocks. So during that financial year, we have actually produced and sold 92,000 tons of pipe coating material with the value of 37.8 million ringgit. Right. So this is the translations of what we have mined from our resource into a product that we sold. Right. It actually generated 37.8 million ringgit of values for our FY 2020. So on the right bottom here is that we have actually also produced and sold 557,000 tons. Dry metric ton means we take out the moisture from for the iron ore concentrate that we sold to the local steel mill. So it actually produces or contributed about 199 million ringgit. And what actually came as something surprise to us was that, as you can see on the top of the right, we actually sold waste. This waste actually is something, is a waste from our processing process, right? And because it still contains some elements of iron ore, and due to the high price that we have witnessed in the past year, so we able to sell 212,000 dry metric tons of waste or tailing that actually contributed 17.6 million ringgit to the company. And actually, because the waste is a waste, so there is a zero cost assigned to it. So arising from that activities, then we would like to share with everyone of you regarding our financials. So obviously 2017 and 18, these two were not good year, because ever since the second half of year 2014, we have witnessed iron ore price has plummeted, and also it has been there for quite some time until 2018, when the price started to rebound. So as you can see, from 2017 until 2020, we have a cumulative average growth rate of 41%, from a total turnover of about 64 million in 2017 to 254 million in the FY 2020. So that is actually, first thing is due to the certain mining program that we have undertaken back in 2016, 17, 18, and together with the increase in the selling price of the iron ore. So because of that, we can also witness the upward trend of our profit from the gross loss in the FY 2017, it's about close to break even in FY 2018, to a positive contributions in the 2019 and 2020. So in 2020, we have actually reported a GP of 107 million ringgit. So it is something very promising performance in the 2020 financial year. So as a result of those good performance, and you can see in our current asset to non-current asset ratio, and which previously in 2017, we only have 42.5 million of total current asset. But when it comes to 2020, it has actually increased to 188 million. And this 188 million, 150 million was actually cash and bank balance, and with pretty low gearing, right? And the table on the right, actually it shows that how much is our liabilities, current and non-current liability. And for the FY 2020, it was only about 26 million, right? So it's very low, and compared to the cash that we have in hand for the FY 2020 was about 150 million. So a little bit of our share performance, as what Geoff have actually shared just now. So the price, our offer price was 25 cents, and we were actually listed on the 28th of June, right? And the reporting date of 29 January shows that the price was closed at 36.5 cents. So with that, the PE was at 8.5 times, with the PB of 2.4 and also dividend yield of 1.64%. Let's bring it to the industry outlook. Okay, so market enablers. So actually, right, what we can witness so far is that there is a rising demand in China, all right, and of course around the Southeast Asia regions due to the fiscal stimulus package, and which actually give a boost to the iron ore price. So as we can see, is that China import of iron ore actually has recorded all-time high in 2020, jumping 9.5% from the previous year, and to reach 1.17 billion tons, right? So they imported 1 billion tons from everywhere in the world. So this is also that their steel miller needs to actually replenish their inventories in the early 2021, right? And of course, across the globe is that many countries actually rolling out their stimulus package. So that also boosting the investment and also the spending, and which iron ore is one of the important ingredients in the construction industry and even for the development. And so is in the Southeast Asia country, right? So due to that, right, the favorable macroeconomic environment and coupled with the strong balance sheet and of course the quality of the iron ore assets that the company is having, like what we are talking about, we have extracted more than 5 million tons since 2008, and we still have these healthy resources available, over 1 million tons. 5 million tons of reserve, and so we have actually a very good prospect, and obviously that mine needs to be run, the company needs to be run by the experienced key management, and we have very strong combinations of the key management. Right. So what is the strength of SAM? SAM actually is being built based on the 11 years of the production and sales record. So this is a testimonial, and the fact that we still have a good amount of the resource available, and also with our ongoing dream program. So that is something that we hope that it will actually end out with something promising for the future reporting. Then besides that, we also have a very good team and with the extensive knowledge in the mining experience, because we have been in the industry for long, since 2008, and the key management personnel also have a very long experience in doing the mining. And also, of course, operational cost is something that also an important element, and as we have also one of the reasons why, or rather, utilization of the IPO proceed also is banned for our infrastructure, which is inclusive of the electrical supply from the national grid. So we hope to commence that in the FY 2021 as per our plan, and with that we believe that it will actually help to reduce our cost. And lastly is that our product, we are not only relying on one particular industry, right? It's not only the steel industry generally, and we also supply to the oil and gas. So we have two types of product for two different markets. So coming to the strategy, of course, as a mining company, we will have to continue to carry out our exploration program with the view that, and also with the hope that we are able to expand our resource base and also to prolong our life of mine, right? So this is one of the key ingredients. And in fact, what we'll say is that about from the initial planning, we actually allocated close to 23% of our IPO proceeds for the explorations program. And of course, the next part is that we believe in investing in the equipment, which will enable us to generate the cash flow. And also based on our initial IPO program, we actually allocated about 16.7% of the IPO proceeds for the investment into the equipment and everything. And also recently, we also have announced to reallocate our IPO proceeds and to utilize more for the purpose of investing in the machinery and equipment. And of course, at the same time, we also do not neglect the needs to do the acquisition, and we definitely plans to expand through the acquisitions or JV or strategic alliance. With that, we actually hope that we are able to grow Southern Alliance or SAMS to bigger size or intermediate mining company. With that, actually, I end my presentation. Thank you very much.
Thank you, Mr. Lim. In our last segment for today's Corporate Connect, we'll have a Q&A session. So should you have any questions, you may post your question in the Facebook comment section. And due to time constraint, we will try our best to answer all questions, but we also seek your understanding that not all questions may be addressed. So without further ado, we would like to invite the moderator, Mr. Richard Dyson, the General Manager, Planning, Education and Research from SIAS, as well as the panelists from Southern Alliance Mining Ltd, Mr. Lim Wei Hong, CFO, Mr. Tan Lee Kun, the Corporate Advisor, and Mr. Shivam Saraf, the Investor Relation. Over to you, Richard.
Thank you for joining us, and congratulations once again for an IPO during our circuit breaker, your MCO. I'm sure it was not that simple to do. I think that is itself is a whole different topic, which we can have a discussion another day. And also thanks, Geoff, for your quick overview. But perhaps I'll start with a combination of the market plus some guidance for investors, and I'll put it to Wei Hang first. So commodity prices really have surged. We've seen a surge in December, led by about 15% in oil prices, according to the World Bank's Pink Sheet report. Metals also surged more than 10% right across the board, with components moving even higher, like iron ore. We see 25% increase in December, copper 10%, tin and nickel at about 6.5% each. Given this positive outlook of commodity prices, I'm going to ask a different question. What are some of the risks and challenges that you would expect to face moving forward? Can you share them with investors?
Thank you for your question. So obviously is that the most challenging part, right, for every miner is that the continuity to carry out and to produce the iron ore. And of course, with the present high price regime, then the incentive is much more. That is one of the reasons why we actually invested heavily. And in fact, we have actually fully utilized our IPO allocated, proceed allocated for the CAPEX, so that we are able to further increase and boost up our mining capacity. Because in the mining is that it's not every day that you can get your ore, right? So it goes by the rightful activity. So this is I would say the biggest challenge. Of course, when the price goes up so high, I mean, everyone also get excited. But and again, this is another risk is, I would say, expecting managing the expectations of everyone.
Correct.
Right.
I mean, it's great if we'd have this every day, but it's not that simple, you know what I mean? And that is always that challenge, you know what I mean, is managing demand. But let's going back to talking about a little bit more about the company. And you mentioned earlier about the IPO proceeds as well. And recently, I think in January, you announced that 1 million intended for the proceeds for acquisitions, joint ventures, alliances. These have been reallocated for the purpose of investment into mining equipment infrastructure. At the announcement, about 3.8 million of the 11.9 million raised were utilized. A significant portion, about 3 million, were utilized for purposes of investment into mining equipment infrastructure. So what prompted management to make these reallocations? Can you share a bit more insights? I think you see some differences, and I think you beginning as you alerted to some changes as well. Could you share some of these with investors?
Yeah, absolutely. So basically, is that what we can see is as a responsible company, we're definitely going to utilize the proceeds as careful as possible and in the most efficient way as possible. So as while we are still waiting for the opportunity to invest in other or through another M&A, so we see there is a need to further increase our capacity so that we can actually tap onto the high price regime. So in a way, is that because when you do the mining, the mines development work, so there are a lot of those ways that you need to remove. So what basically is that you should do it when the price is so well, right? So you should intensify so that even though it is costly, you will eat into your profit, but it's not so painful as compared to when the price is slumped. But because eventually you have to do that work anyway. So this is a way of to manage the cash flow as well, because due to the high price regime, then you have more to spare for those activities. So then we are not worried. It means that you just prepare ourselves for the rainy day.
Now, what about this risk, you know, this MCO right now in Malaysia? You know, I mean, these are challenges that you can, I mean, you know, unfortunately, we live in this sort of world today. And I mean, and then we have social distancing. These are other challenges. How do you see, how are you guys managing this? Are you living in I think you also, how are you going to celebrate Chinese New Year?
Yeah, absolutely right. So, okay, the lucky part about this is that because this is, we are now entering a so-called an MCO 2.0, right? It's unlike the first MCO, which was pretty strict, but during them, we were given the approval by the Ministry of International Trade and Industry to allow to operate. And of course, we're talking about the social distancing, and the beauty part is because every single operator actually operate a single machine. So they are confined to their own world. So and most of our sites are actually open space, right? And we have the beautiful sun, and will give you a lot of this vitamin D, right? So of course, that is one part of the challenge, but I think we managed to sail through. And during the MCO 2.0 recently announced by the government, and they see the impact of the first MCO. So they actually not really like tightening up the control over the economic activities, but it's more toward the social events. So this year, unfortunately, we have to have reunion dinners via Zoom.
Oh dear, yes. I think Singapore is also having the same situation. Geoff, I just want to bring you in terms of looking at some of them. We've obviously, you've seen the US, you know, the prices of S&P has just risen even as a result of this COVID situation. You know, I mean, while at the same time, you know, our STI hasn't actually grown as much. Is there? What do you think? Is there? Do you suspect there's some reallocation towards, you know, more of the emerging markets going along. I think some analysts are saying that maybe the US is overpriced and maybe some reallocation towards emerging markets, like looking at SAM, for example. Should investors reallocate towards emerging markets?
Yeah, interesting question, Richard, because I think performance wise, everything is so staunchly sector driven. Our healthcare, our tech stocks have done very well last year, but the thing is they don't make up a majority of the index that we see in the US. So for our financials, for our real estate, for our hospitality, for our tourism, for our consumer orientated, they have performed quite competitively with those other sector peers across the region and across the world, because all these various industries, they face the same challenges ultimately. But look, for the region, I think the allocation is maybe not so much a reallocation, but look, we have incredible growth here in Asia that ASEAN's a part of, China's a part of, and that is really changing that old adage that you produce in the East and you consume in the West. We're fast seeing production in the East and consumption in the East, and e-commerce technology is playing a big role for that. The fact is, for China, which is obviously, as we said, a very important demand contributor to iron ore, for China to really transform into a consumer economy, it has to get a lot of those household savings that are in, maybe real estate assets, and get that money working into the consumer world. And e-commerce and online shopping, that is going to be a big enabler, particularly in China, where you had the demographic dividend. So I guess we've got our own intrinsic growth, organic growth, Richard, and we're seeing that ultimately being a key driver, the rise of the Asian consumer, which will ultimately help power and make the growth here more self-sustained rather than exporting per se. And that, I think, will be the major pull for the capital flows and the foreign direct investment and so forth. So, we saw the FDI and so forth, the capital flows really come off last year, but that's basically China was able to maintain it while the US came off significantly. Okay, so I might just also add, mate, that quickly, and I'll say no more, but on the excitement for the stocks and the outlooks and the financials and so forth, as always, and I know you and Mr. Gerald are always encouraging investors to always seek checks and balances. You can have some exciting fundamentals, but you can also incorporate valuations with those fundamentals to help provide the checks, and also avoid concentrating portfolio to one stock or asset to provide some balance.
You're talking about avoid the GameStop issue.
Yes,
I will name it. And I think we had that previously. I think it was a few years ago. It was the Three Musketeers. We had them. So it is painful, and it wiped out $8 billion of investors' money. And I think we can't, it took a long time for investors to really recover from that. The 3 penny stock crisis. And I think investors really have to be careful.
And look, when it comes to choosing what stocks to follow and so forth, we've got this great increased digitalization in the financial services, which basically retail investors, they have so much access now to information, data, research, education, and so forth. But at the same time, remember the foundations of the business. It's well-capitalized brokers that manage their value at risks very closely. And if they're publishing research or they're making a call, they have to have a good reason to say it. They have to be providing that call or that advice in line with regulatory requirements, keeping records, making sure there's a sound basis to make the call in the first place. So that's one thing I think I just wanted to just point out. It's a good reminder for us that was for the last couple of weeks that you know, we should stick to what works over the long run.
Yeah, thanks, Geoff. I think we're almost running out of time. I just want to close off with Wei Hang with one last question in terms of if you were to ask in terms of what is the competitive advantage, if you reiterate what is the competitive advantage of SAM versus, you know, and what would it be, you know, why should we look at SAM and what is the competitive advantage vis-a-vis your other clients, and why should we be investing in you?
Right. So thank you for the very last question. So of course, the most important part of any stock, like what Geoff was saying, is that the fundamental of it. So we have a good track record, and we also have reporting a good these resources and reserve moving forward, because eventually your financial result, it depends on your resources and reserve, right? And also not to forget is that we have a strong, solid team, management team with the vast experience. We are not just here for a couple of years. In fact, we are in the industry for more than 10 years. And we believe that with the right mindset, with the proper settings, we are able to perform better in the future.
Thank you. I think we will take that point with you, and then we will probably do some sort of a one-on-one interview with the management team. I think people may want to understand, because it's still a newly listed company on SGX, and I think the team needs to be understood more by investors. Thank you very much, Rehan. Thank you, Geoff. I'll hand it over to Julian. Thank you.
Thank you.
Thank you, everyone. We have come to the end of today's session. It has been a pleasure to have you with us today. In case you have missed any part of today's session, you can rewatch this session on SIAS Facebook page. Do like our page and check out our website to get more updates on our upcoming investor education programs and initiatives. Thank you, and have a great evening ahead.
Thanks, everyone. Happy New Year. Gong Xi Fat Choi.
Thank you. All right.
Stay safe, everyone.
Thank you. Happy New Year.